In Chapter 19, we're going to look at two problems as practice problems, P19-2 and P19-12. First, let's look at P19-2 on page 1144. Passner Brands is a calendar year firm with operations in several countries. As part of its executive compensation plan, at January 1st, the company issued 400,000 executive stock options. And remember, a stock option is giving the holder the ability to purchase stock at a discounted rate. So these stock options permit executives to buy 400,000 shares of Passner stock for $34 per share. 1/4 of the options vest in each of the next 4 years. So they become eligible to be collected by the executive 1/4 each year. So they have to stay basically for 4 years, but each year 1/4 of them will vest. Passner elects to separate the total award into 4 groups or tranches according to the year in which they vest and measure the compensation cost for each vesting date as a separate award. The fair value of each tranche is estimated at January 1, 2018 as follows. So we need to determine the compensation expense related to the options to be recorded each year. Remember, they are providing work while they're earning the right to have these stock options. So the value of these, or a certain amount, must be recorded as compensation expense each year. Now, we're going to determine this, assuming Passner allocates the compensation expense for each of the 4 groups or tranches separately. So first, we have each group's vesting date as is going to be looked at as a separate award, and allocate the compensation cost for each of the 4 groups according to this vesting schedule, and the fair value of each option is listed for those dates. So when December 31st, 2018 happens, which is a year from January 1, 350 will be the amount that vests. 400,000 are the total amount of options. 25% of them, or 100,000 will vest. So that's really 350,000, right? So 350,000 will be the amount of stock option compensation from the vesting of that first tier of stock options. Now in the next year, another 400,000 will another 25% of the 400,000, or 100,000 will vest at $4 each. Now, half of those are considered compensation in 2018, half in 2019. Even though they all vested in 2019, we spread it out over the entire compensation time to date. Same with the next year. 100,000 vest times 450 will be a total of 450,000, but spread the 450,000 over 2018, 19, and 20, the prior 2 years and the current year. And then in the final year, when the last 100,000 vest at $5 each is their fair value, we'll spread that out over the 4 years. So add up the compensation for each column. According to this method, 825,000 is compensation expense in 18, 475 in 19, 275,000 in 2020, and then 125,000 would be vested or a compensation expense in 2021. So the total amount of compensation related to these stock options is $1,700,000. We just spread it out over the time period that the individuals have to work and ultimately have these stock options vested to them. Now, a company must have expensed at least the amount vested by that date. The allocation here meets that constraint. So The $825,000 recognized in 2018 exceeds the $350,000 total vested. The $1.3 million, 825 plus 475 expense by 2019 exceeds the total of 750,000 of the total vested thus far, etc. The December 31st, the 825 from 2018. Oops. Oh, I'm sorry. For 2020, 1.2 million. Okay, that's a little bit off. Let's see. Oh, no. Yes, it is. I'm off a little bit here. That should be 825 plus, not 475. Oh, no, I'm right. For 2019, the 825 plus the total compensation for 2019 of 475 plus the total compensation of 2020 must exceed the total value of the vested items through 2020. And they do. They're 1,575,000 compared to the 350 plus 400 plus 450, or 1.2 million. Now in requirement 2, so sorry, back up. That's how we determine the compensation expense related to those stock options under that method. In requirement 2, determine the compensation expense related to the options to be recorded each year, assuming Passner uses the straight line method to allocate the compensation expense. Well, we know the total compensation expense related to these stock options and the way they vest is the 1.7 million right there. Highlighted there, right there. So instead of allocating it according to a vesting schedule, what we're going to do is just straight line it. 425,000 each year. Just as long as we're expensing more than the amount vested by each year, we are fine with expensing straight line. Okay, so stock options, the key here is that we determine a total compensation expense related to them and then allocate that expense to each year that the employees are performing services to have the ability to use those stock options. So that is problem 19-2. Now the other part of our chapter dealt with earnings per share. And that's what problem 1912 is. So let's take a look at that. Now, get up there first. Okay. Earnings per share is a very important calculation for our financial statements and for the investment world. Earnings per share, basic earnings per share, is calculated by taking net income for the year, subtracting out preferred dividend amounts, because we want to isolate the net income the company made just for the common shareholders. So we know part of the net income is already promised to preferred shareholders, subtract that part out, and the part that's remaining is the part promised to common stockholders. And then we divide that amount by the weighted average number of common stock outstanding for the year. That gives us reality. That is where our earnings per share is at. We call that our basic earnings per share. What happens and what the issue is with earnings per share is sometimes we have these items out there like stock options that could add more common stock. Maybe we have bonds that could be converted to common stock. So we have items out there that could potentially become common stock. What the FASB wants us to do, is to pretend that we converted everything that could be converted to common stock. We converted it. We're not doing journal entries or anything within our accounts. This is just a separate calculation. So how would net income change if you converted everything that could be converted? And how would your outstanding shares change if you converted everything you can? And once you have those amounts, we calculate earnings per share. And if that amount is less than our basic earnings per share, we call that diluted earnings per share. And you could think of it, and I put it on the discussion board. It's kind of like you make Kool-Aid, right? Make it according to the directions. That's considered basic earnings per share. But what if you added more water, or you added, in this case, more common stock? What would happen to the Kool-Aid? It would get diluted. It would become more watery. Well, that's what happens with earnings per share. It decreases normally. So diluted earnings per share provides decision makers with worst case scenario earnings per share. Here's what earnings per share would have been if everybody converted these special items into common stock this year. So it doesn't mean that's what it is. It just gives the worst case scenario for earnings per share. So that's what we're looking at in 1912. Now, when it comes to these items, if you have more than one, you have to determine their effect. Some of these items, if they're converted, cause earnings per share to go up. And if that's the case, we don't include them. We're only concerned with items that will cause earnings per share to be less. So December 31st, Dow Steel had 600,000 shares of common stock, 300,000 shares of 8% non-cumulative, non-convertible, so the preferred stock can't be converted to common stock, issued and outstanding. Dow issued a 4% common stock dividend on May 15th. And paid cash dividends of $400,000 and $75,000 to common and preferred shareholders, respectively, on December 15th, 2018. On February 28th, Dow sold 60,000 shares in keeping with its long-term share repurchase plan. 2,000 shares were retired on July 1. Net income for the year December 31st, 2018 was $2.1 million, and the income tax rate is 40%. As part of an incentive plan, Dow granted incentive stock options to division managers at December 31st of the current year and each of the previous 2 years. Each option permits its holder to buy 1 share of common stock at an exercise price equal to market value at the date of grant, and can be exercised 1 year from the date. Here's the information related to the stock options information. Compute Dow's earnings per share for the year ended December 31st, 2018. Well, earnings per share itself, so here's our basic earnings per share. You take net income. Okay, so what's the net income for the year? 2.1 million. The assumption is the income tax has already been subtracted. Remember, we want to isolate the part of net income that's only available to common shareholders. So since this company has preferred dividends and they paid $75,000, we want to subtract that $75,000 out. So the amount of net income available to common stockholders is $2,025,000. Now the second part, we need to calculate the weighted average common shares outstanding for the year. So the first thing we say is, what did we start the year with? 600. Okay, just use the 600. During the year, so we move on. February 28th, the company sold 60,000 more shares of common stock. So they added 60 more, and those were outstanding for 10 of 12 months during the year. Okay. It repurchased 2,000 shares on July 1. I just want to take a step back now. Before we go to the next to July 1, let's take a step back. They issued a common stock dividend on May 15th, 4%. So that means any stock that was outstanding was included in that dividend. So those 600,000 shares that were outstanding for the entire year, 1.04% more were outstanding for the entire year. That's how we assume. We assume the dividends happen as of the beginning of the year. Same with those 60,000 new shares. So we're going to add an additional 4% to those amounts. In July, when we repurchase 2,000 shares, we're going to subtract those 2,000 shares that were treasury shares for 6 months of the 12. So you calculate the information, so 600 times 1.04 plus 60 times 10/12 times 1.04 minus 2 times 1/2 or 1,000. So the weighted average outstanding shares are 675,000. So when we have a stock dividend, we have to readjust those shares before the stock dividend as if they were in the stock dividend. Why? Because shares going into the future will have that stock dividend amount. So we just assume it happened as of the beginning of the year. Now, that's the first part. That's just regular earnings per share. You divide that 675 into the amount of income that was made for the common stockholders. $3 is your basic earnings per share. That's reality. Now from there, we have to determine diluted earnings per share. So let's take a read back up here. It says, the options issued in 2017 are not considered when calculating the 2018 EPS because the exercise price of $33 is not less than the average price of stock of 32. As a result, these options are anti-dilutive. Okay, so what this means, well, let's keep reading. The options issued in 2018 do not affect the calculation of 2000 earnings per share for 2 reasons. Related to their being issued at December 31st, first, the exercise price is 32 and the average market price is 32. So there's a 0 result. While they are not anti-dilutive, they are not dilutive either. Second, even if the exercise price had been less than the market, these options would be excluded. Options are assumed to exercise at the beginning of the year or when granted, whichever is later. When granted in this case, so the fraction of the years the shares are assumed outstanding is 0/12. So there would be no additional shares. But what about 2016? The options issued in 2016 are considered exercised for 8,000 shares at $24 each. Okay, so 8,000 new shares would have been issued. Now remember the rule here. We would take those proceeds. When we're calculating this, we pretend we take those proceeds and immediately buy treasury stock back at the average market price on 2018. Okay, so when the people, the executives paid the company $192,000 for those additional 8,000 shares, the assumption is the company immediately takes that and buys back shares as treasury stock out of the market at the average price on December 31st. So let's see how this impacts our calculation. Well, the company would assume on December 31st, they sold 8,000 shares because the executives exercised their stock options. So they gave the company $192,000. The company gives them 8,000 shares. Now we're not saying that's what happened. We're pretending. We assume this happens. The company then would immediately take that money and buy back treasury stock. So at the average price on December 31st, 2018, the company would pay $32 a share. That would allow them to buy 6,000 shares. The assumption is that it happens at the end of the year. So, I'm sorry, at the beginning of the year. The assumption is that it would have happened at the beginning of 2018. So those shares would have been outstanding. The difference between the new shares that would have been exercised minus the treasury shares that would have been repurchased, those 2,000 shares are considered outstanding for the entire year. It did not happen. We're just saying if they were exercised as of January 1, and if the company took the proceeds and bought treasury stock, how much would our common stock have increased? And it's 2,000. So to calculate diluted earnings per share, take your net income minus preferred dividends divided by your new weighted outstanding common shares. See how we've shown the impact of additional shares of stock because people would exercise their stock options? This is the impact that would have happened if they actually did. Our earnings per share would have been $2.99. So let's take a look at that 2017 number one more time. What are they talking about? It would be anti-dilutive. Well, going back to the calculation above, what would have happened? Well, the company had 3,000 shares. 3,000 shares. The exercise price would have been $33 a share because that's the amount that's on the stock option. So the company would have received $99,000. Now, if they immediately take that $99,000 and buy treasury stocks back out of the market at the 2018 market average market price there, 99,000 divided by 32, they would have bought back 3,000, just to round it, 3,094 shares. So they would have bought back more than they sold. So the impact down on our equation here would have been to decrease the number of shares outstanding by 94. Well, that causes anti-dilution. What do I mean? Well, let's say we did include that here. We would have 2,025, right? Oh, I don't want that small. Let me see if I can get this a little bigger here. Our net income of 2,025 minus, 2,100 minus the 75 divided by that whole calculation there. So our 675 outstanding shares plus the 2,000 that we just assumed exercise from 2016 minus 94. So if you calculate that, 677 minus 694, no, 677 minus 94. Our formula would then be 2,025 divided by 583 shares, which would have caused our earnings per share to be, now this is diluted earnings per share, $3.47, which is higher than our basic earnings per share. So when that situation happens, it's anti-dilutive. We don't care if this would cause our earnings per share to go higher. We like that. We're only worried about reporting to people when these types of conversions could decrease earnings per share or dilute it. So if it's anti-dilutive, like we just saw here, we would buy back more stock than we actually sold when these stock options were exercised, then we ignore it. We don't include it. Okay, so that is how diluted earnings per share work. So if you have any kind of questions on this, I know this is just one little aspect of it. Nobody posts any questions, and I can't believe you don't have any. You've got to get questions out there to the discussion board. This is getting very complex, and I know it's hard to understand. So please, I'll respond to your questions, get them out there, and hopefully we'll get them answered, and this will be much clearer.